Students, today we're going to look at calculating the allowance when you write off accounts receivable. So you need to go to your blackboard under Test 5 material. It's going to be the third item down, PowerPoints from Chapter 9. The handout I'm using comes from the link where it says Handout on Calculating the Allowance, and it also has a homework problem attached. So go there, pull that up, and this is what it looks like. I'm going to go to my hard copy here. Okay, talks about Music Land across the top. So get that out. Let's pull it up and let's work through some problems. Let me get the PowerPoints pulled up for us. Now, there are three methods of calculating the allowance. You've been doing journal entries on estimates. Okay, so we're talking about the estimate here. Okay, let's go back to the PowerPoint. Now, it says two methods, but in all actuality, these are two categories with three methods. Percentage of sales method. Then you have accounts receivable method, which consists of two. So we're going to look at three different ways to get that estimate or that allowance account. Okay, so let's go back to our problem here. Let's read what it says. Music Land has credit sales of $400,000 in 2011. It is estimated that 0.6% of the credit sales will eventually prove uncollectible. Okay, let's look at what bad debt expense is. So here's the journal entry that we're interested in. Let's write it up here at the top. Okay, the journal entry is under the allowance method, and it's when you debit bad debt expense and you credit allowance for doubtful accounts. So we're looking at what number do you put in here. And so there's three ways to do that. Okay. The first one that we're looking at is called the percentage of accounts of sales. Percentage of sales method. Okay. So what we want to do here is we want to take our sales, which is $400,000, and we want to multiply it by this percentage. Now the only catch here is you have to change that percentage to a decimal before you can do your multiplication. Notice where the decimal point is. This is 0.6%. In order to drop the percent sign, you move the decimal two places to the left. Two places to the left. I was going right. So go two places to the left. That means you have two zeros. Put your decimal point there, right before the zeros. That gets rid of the percent sign, and then you can use the multiplication. So 400,000 times 0.006 is going to give you $2,400. $2,400. So now when you're down here and you're making this journal entry to debit bad debt expense and credit the allowance for doubtful accounts, the dollar amount that you will put in that will be $2,400. And this is to record the estimate. And again, this is under the allowance method. This is the first entry under the allowance method, which is required by GAAP. Okay. Now, let's go on to the second example here. This time, Music Land has $50,000 in accounts receivable, a $200 credit balance in the allowance account already, which they didn't mention in the first problem. Okay. Past experience says that 5% of receivables are uncollectible. Okay. So we are going to have to do a multiplication here. This one is called the percentage of accounts receivable method. Okay. Here's our accounts receivable, $50,000. We want to do a multiplication times the percentage. Now notice the percentage here is 5%, but you need to change it to a decimal. So your decimal point is going to have to be moved 2 places to the left. Right now it's behind the 5, so if you move it 2 places to the left, that means 1 0 is added. Unlike the other one where you had 2 zeros, because notice where the decimal was. So you move 2 places to the left. In this case, the decimal point is between the 5 and the percent sign. It's not showing, but you have to know that. Okay, so to do your multiplication, 50,000 times 0.05 is going to give you $2,500. Okay, now that's what they want in the allowance account. In this method, you have to consider what's already in there. Notice the allowance was credited in the other one, and that's what you would do here. Your journal entry is going to give you a credit, and the balance you want in this method is $2,500. Well, if you already have $300 there, okay, then what you have to do is to make a journal entry to make up the difference. So here our journal entry is going to be for $2,200, you see, because the two numbers have to add. So in your journal entry, bad debt expense, you're going to put $2,200, and the allowance account for doubtful accounts is $2,200. Okay, so here's your journal entry. I'm trying to work around the work that I just did, okay, and trying to hold my phone at the same time, okay. So notice the difference here. In the first method, you did not have to adjust for any balance that was already there. Whatever you came up with is what you did the journal entry for. Here, if there's already a balance in there, you have to subtract that from the amount that you get when you do the calculation. So keep in mind that I can ask you 2 questions off this. One, what is the dollar amount for the estimate once you calculate it, the allowance? That would be $2,500. Second question would be, what is the dollar amount that you want to do the journal entry for? That's going to be $2,200. So please take a note of the 2 different ways this can be asked, okay? Now I want to look at the last method. This one's a little bit more complicated. Let me take you back to the PowerPoints. Okay, on your PowerPoint slide, let's see, 9, this is called the aging of accounts receivable, and it deals with accounts receivable. This is a method that is used by hospitals a lot of times. You'll go in and they'll have to file insurance, so they're not going to make you pay until the insurance is paid. So it may take sometimes 60 days to get insurance to pay you. So in the meantime, they send you these bills that say, this is the amount you owe. They'll send it 30 days after you've been in the hospital, and then they'll send you another one in 60 days. Finally, insurance will pay sometime between 60 and 90 days, and so your bill might be due about 90 days. Sorry, my dogs are barking. I'm doing a video here. So, you want to classify each receivable with how long it's past due, put them into age groups, and estimate the bad debts for each age group, here, okay? When they say age group, they mean how far past due, not how old you are, okay? And this is the example, this is the problem we're looking at. So let's go through here. And basically you're looking at, in the first case, you have $37,000 in accounts receivable, but it hasn't been there very long, okay? This is like when you first go in the hospital. So the percentage that they expect that would not pay would only be a small percentage, which would be 2%. Now, your decimal point will be behind the 2, will be behind each of these numbers, so you want to move it 2 places to the left. That's going to mean 0.02 is what you do the multiplication by. So multiply 37,000 times your 0.02, 0.2. Okay, 37,000 times 0.2. 6, 7, 8, 810. Wait a minute, $740. Looking at dollar amounts here, so $740. The next one you're looking at 0.05 times 6,500, and that's going to be $325. The next category is between 30 and 60 days. This is about the time insurance starts to pay. So if you move your decimal, that's going to be 0.10 times your 3,700. So that's going to be $370. Now, I want you to notice that the percentages get bigger. These are the percentages of people that they don't expect to be able to collect. So, in other words, by the time you get between 60 and 90 days, about 25% of this will not be collected. Okay? And then when you get over 90 days, about 40% won't be collected. So the longer the time goes, the greater the chance of the amounts not being collected. They get preferably bigger. So change your decimal, 0.25 times 1,900 is $475. And then on the 40%, it's going to be 0.40 times your 900, and that will be $360. Now, of course, you have computers to go through all of this, and they can do it fairly quickly, but at least you understand what's going on. Add all of your dollar amounts. Okay, this is the amount of the estimate or the allowance. So if you add all of that, it's going to come up to be $2,270, it looks like. So in A, it says determine the estimate for the allowance account. Okay, the amount's $2,270. But we want to prepare the journal entry . Okay, so the dollar amount, now in this case, you do have to look at what's already in the account. So let's pull our video over. If you already have $200 in the account and you want a balance of $2,270, then the dollar amount of the journal entry has to be the difference between these two. So you're looking for a number here, and if you subtract what's already there from the balance you want, $2,070 will be the amount that you put in this journal entry. So keep in mind that on the last two, the accounts receivable ones, where you're multiplying times accounts receivable, is where you have to adjust for whatever's already in the account. On the percentage of sales method, which is the one we did up at the top, you don't have to worry about what's already in there. Okay, they're not concerned about that. Do watch your decimal point. Okay. If you can't see it, then it's going to be between the whole number and the percent, and you move it 2 places to the left. Okay, so watch your decimal point. This one, it was before the 6, so you move it 2 places to the left before you multiply. Okay, one other slide that I want to look at is a summary of these methods, and this is on slide 13. On the percentage of sales, it's a focus on the income statement, okay, and it tells you how to calculate it. You don't have to adjust for what's already in there. On the last two, they're balance sheet focused because you're multiplying times receivables. So take a look at that. Know which one's which ones you have to adjust the allowance for, okay, and watch my questions on the multiple choice. Remember, I could ask you what is the dollar amount that the journal entry is made for, in which case you would have to make the adjustment for the allowance. What is the dollar amount of the estimate or of the allowance? Okay, and that would be the number that you get as soon as you multiply without any adjustments. Okay, for this method, it's the same number. Now let's see if that's the end of that chapter. Homework is on that second page, and it will need to be, let me turn it this way, you can see, okay, it will need to be filled out and uploaded onto the link under the assignment tab, okay? Now, good luck on all that. That's due Friday by midnight. Email or text with questions. Thank you.